Gold prices. China buys 20% of global gold mine output in 5 months. Gold prices could be setting up to outperform other assets. Just look at the buyers. If you are worried about daily fluctuations in gold prices and are forgetting the big picture, you could be making a big mistake. This is a bold statement, but don't be shocked to see gold prices outperforming a lot of assets in the next few years. You see, gold isn't getting much attention these days, and rightfully so. The yellow precious metal hasn't done well at all. Investors tend to ignore things that are underperforming, but sooner rather than later, this could turn. Know that we have big buyers remaining in the gold market. Their actions tell us that they want a lot more of it. Russian central bank remains consistent gold buyer since 2006. For example, look at the Russian central bank. Russia, over the past few years, has come under fire, and a lot of sanctions have been placed on the country. So the Central Bank of Russia is doing all it can to insulate itself. It is buying a lot of gold because the yellow metal is great at this. In July, the Russian central bank bought 26.1 tons of the yellow metal. It now holds 2,170 tons in reserves. The gold purchases in July by the Russian central bank were the highest since November 2017. Also, know that since July 2006, the Russian central bank has been a very consistent gold buyer. It is really hard to conceive the idea that the Russian central bank is done buying gold. It may need a lot more to protect its reserves. The precious metal it has on hand is worth just about $80.0 billion. China buying a lot of gold. China is worth watching closely as well. It is not only the consumers in the country who like gold, the People's Bank of China likes gold too. We are seeing a lot of gold going into the country, and it doesn't look like gold prices matter to the buyers whatsoever. In June, 80.87 tons of the yellow metal was imported into mainland China from Hong Kong. This was the highest amount since March 2017, and 40.3% higher than the previous month. Look at the bigger picture. In the first 5 months of 2018, China imported 604.90 tons of gold from Hong Kong, Australia, Singapore, Switzerland, and the United Kingdom. Putting this 604-ton figure in perspective, the global gold mine output is around 3,000 tons. So, in the first 5 months of 2018, China imported an amount equivalent to 20% of the global gold mine output. Don't ignore the gold miners, dear reader. I can't stress this enough. The big buyers in the gold market could send gold prices much higher. While the mainstream is focused on which company is going to be the next trillion-dollar company, I am watching precious metal miners. The recent sell-off in gold prices has made them an even better opportunity. Let me give you an example, and I will end with it. Keep in mind that this is not a buy recommendation. It is just an example of how cheap miners are these days. Goldco Inc. has a market capitalization of $8.9 billion. The company has 53.51 million ounces of proven and probable gold reserves. These are the reserves that are feasible to mine at a 1,200 an ounce gold price. Mind you, Goldco has an immense amount silver and copper reserves, as well as massive resources. Doing simple math here, at Goldco, each ounce of gold reserve in ground is priced at just about $166 an ounce. Nothing can hold gold prices back any longer. Change in Fed plans isn't the only factor pushing for higher gold prices. Federal Reserve Chair Jerome Powell recently delivered some choice words at Jackson Hole, Wyoming. He signaled a reconsideration of the Fed's interest rate policy. Interest rates now may not increase as much as expected. That means a few things, but as far as investing in precious metals is concerned, it suggests that gold prices will start bouncing back faster than anyone expected. Unfortunately, some investors will simply use the revised, more dovish interest rate trend to double down on higher risk investments, like equities. They will follow the standard logic, whereby lower interest rates will stimulate the markets. The indices will rise again, pushing stocks on Wall Street to new highs, perhaps surpassing the lofty heights achieved in January, with major upside technical violations carried out by the S&P 500 and the Nasdaq, or perhaps not. Logic will return to the markets. Certainly, if logic returns to the markets, many stocks will collapse. At the same time, a return to logic would also boost safe haven investments. With the all but definitive depression in Bitcoin and cryptocurrency valuations, gold and precious metals will regain their top safe haven investment status, and the price of gold will take a bullish turn. Admittedly, the chance of gold prices rising may still appear as science fiction. After all, conditions have been favorable to gold for some time now. And judging even by the latest gold rally and its fizzling out in August, even the most bullish of gold investors would find it difficult to remain optimistic. Indeed, the rising trade tensions between the United States and China, not to mention the ones between the US and Europe, and the ever more stressed geopolitical environment in general, the price of gold should have already gone up significantly. Instead, investors have not tripped over themselves to grab safe haven assets like gold or silver. The gold price has actually dropped, no matter how dire the effects of the 21st century version of the trade wars might be. More lurks behind the scenes of the latest stunted gold rally. At the time of this writing, the price of gold had just picked up by a few dollars after its latest failed rally. As the chart below shows, gold prices have dropped to their lowest point in a year. Yet the chart offers some encouraging hints. Notice that the recent gold price highs occurred in September 2017, March 2018, and April 2018. There is a common denominator. If there is one thing that has propped up gold, it is the threat of a conflict involving the Democratic People's Republic of Korea, North Korea, for short. Yes, it is North Korea. In the past 365 days, the threat of conflict with North Korea was highest precisely when tensions between Washington, D.C. and Pyongyang intensified. President Donald Trump's meeting with North Korean leader Kim Jong-un last June may have lowered the chance of conflict. But it also caused a slump in gold prices. Behold, not all is lost. The chance of conflict has just intensified again. Not only have tensions between the US and North Korea resumed, they are also more complicated. Perhaps in the midst of the Russiagate investigation and the passing of Senator John McCain, few seem to have noticed that President Trump has asked Secretary of State Mike Pompeo to cancel his planned visit to Pyongyang. I have asked Secretary of State Mike Pompeo not to go to North Korea at this time because I feel we are not making sufficient progress with respect to the denuclearization of the Korean Peninsula. China holds the cards. In keeping with the trade war theme, President Trump has blamed China for having failed to facilitate the peace process between North Korea and the United States. Beijing, admittedly, has no reason to cooperate with Washington, certainly now that Trump has shaken and stirred the principles of the World Trade Organization. The Chinese are sending a clear message to Trump: drop the trade tariffs, and we shall cooperate with your North Korea plans. For all of Trump's ambitions and meetings with Kim Jong-un, prospects for peace in the Korean Peninsula necessarily pass through Beijing. The People's Republic of China, in fact, has been the only country to have maintained close relations with North Korea. It is the only one that can broker a long-lasting agreement, or avert a war, for that matter. Yet, according to Trump's negotiation approach, whereby he pushes even bluffs his adversaries into a corner, there is no turning back from the trade war. Or at least Trump won't back down ahead of the November midterm elections. A lot can happen between now and November. Trump must play to his base. He will therefore continue to use a strong hand against China, while allowing the promise of better relations with North Korea go by the wayside. After all, he can always claim that he tried with the Singapore summit. Trump will also, given the political climate, continue to criticize higher interest rates and the related high US dollar, encouraging signs for gold prices. Given the Federal Reserve's new reservations over its plan to further lift interest rates, Trump might score political points by conducting the kind of policies that will favor gold. Gold should begin a steady recovery over the next few months. Many institutional investors, hedge funds, and the like have held bearish positions on gold. Yet, a hiatus in the Fed's interest rate policy will force gold bears to wake up and smell the storm that is brewing over the equity markets. They will be encouraged to turn bullish on gold before it is too late. The US dollar has served as the main factor influencing traders' opinions, turning them against gold, until now. A euro crisis. The gold price appears to be meeting resistance around the 1,215 per ounce mark. If North Korea A trade war and a suddenly bearish Federal Reserve aren't sufficiently convincing triggers for gold prices to bounce back. Consider the euro. One way or another, the euro and the eurozone could be stepping into a crisis. Italy has entered into a confrontation with the European Union over the migration crisis and the country's debt levels. Meanwhile, the European Central Bank, ECB, announced that it would stop quantitative easing in 2019. The latter move would reduce the strength of the US dollar while increasing tensions in the eurozone, prompting a rush to safe haven assets like gold. Moreover, there is the growing chance of a global recession that could not only stop the Federal Reserve from lifting interest rates, it could force the Fed to reduce them. That would happen just as the ECB hikes its own interest rates, reversing the dollar's gains over the euro. At that point, the gold bears will have no cards left to play.